Hello everyone. Today we're going to be going through the topic of the basic elements of the financial statements, along with assumptions, principles, and the cost constraint of the conceptual framework. So to start off today, we're going to be going through what are the basic elements of the financial statements. Okay, so we're going through the basic elements of the financial statements. Okay. And so what are these things? They are the items that are used to create the financial statements, right? So if we just skim down here really quickly, we could see assets, liabilities, and equity are the first three. And we're going to use those to create something known as the balance sheet. Okay, we're going to do that in Chapter 5. And then we have these last couple of items here, the last four, revenues, expense, gain, loss. That's what's going to go on our income statement. And then we also have a few other items here that help us prepare some other financial statements along with the balance sheet and the income statement. And so the first exam, a lot of the stuff from this class is kind of being very familiar with what are these items and where do they go on specific statements. Like I was just talking about the income statement or the balance sheet or whatever statement it might be. Okay, so first we have an assets. Okay, an asset is a probable future economic benefit arising from a prior transaction, right? And so these would be things like cash, accounts receivable, inventory, etc. Right? A lot of different examples, but those are just a few examples. One asset. Okay, a liability. It's a probable future detriment arising from a prior transaction, meaning that we're probably gonna have to pay out money in the future, right? So this would be something like accounts payables, or maybe if we have a bond outstanding, something like that. Okay, have to pay out in the future for a liability. Okay, equities. It's the residual interest in the assets of the firm after subtracting out the liabilities of the firm from the assets of the firm. Right, so it looks something like this, right? Equities are basically the assets less the liabilities, right? Assets, and then we subtract away liabilities, and then we have our equity, okay? And it's just a residual interest in the firm, all right? Then we and again, equities would be things such as, we have things in here such as common stock. We have our account called retained earnings, etc. Okay, but those are just a few quick examples. Common stock and retained earnings would go under equities. Okay. Next, we have investments by owners. Okay, basically, there's a fancier definition for this, but basically what it means is it's when investors contribute money to the firm. Okay, so when they buy stock, for instance, okay, that would be an investment by an owner. Okay. A distribution to an owner, on the other hand, is when the firm pays out dividends to the owners. All right, so if you're a holder of a stock of a certain company and they pay you a dividend, that would be a distribution to you. Okay. We have this item called comprehensive income, which poses a lot of problems to students. It's sort of a new concept. It's a little bit nebulous. It's sort of vague as to what it really is. But basically, it's the technical definition is essentially all changes in equity of a firm during a year, except for those changes from investments by owners and distributions to owners. Okay, so basically anything that changes our equity, except for these two items that we just went over, okay, that's what comprehensive income includes. All right. And investors are when we pay money to the firm, and then distributions to owners, we receive money from firm if we're an investor. All right, and so anything else that changes equity, that's comprehensive. And so it still might seem a little vague. The way you can kind of think about it is that it's basically your net income, but a little more. Okay, so you add a few extra items. Okay, so it's basically your net income plus a few more items. Okay, that's basically what we're going to see for comprehensive income, and that's basically it for comprehensive income. Okay, revenues, basically just inflows of resources resulting from the company carrying out its primary operations. Right, relatively straightforward. Just the company is receiving cash or other assets for basically doing what it does every day, all day long. Expenses are outflows of resources resulting from the company carrying out its primary operations. Then we have gains and losses. Gains are inflows of resources resulting from the company engaging in transactions that are peripheral to its primary operations, right? So generally speaking, if we, a sale of equipment would basically be a gain. If we sell it at more than its book value, that would be a gain. If we sold some type of an investment or something like that, there's multiple examples, but basically it's something that is not the primary operations of the company that is basically going to be considered to be a gain as long as it's sold at more than the book value than the asset that we're selling. Okay, that's what differentiates a gain from a revenue. And then a loss, it's similar to a gain because it's because of the fact that it's peripheral. Okay, so it's an outflow of resources resulting from the company engaging in transactions that are peripheral to its primary operations. So again, it's an outflow like an expense, but the difference is it's peripheral to the operation. So again, if you sell equipment or you sell an investment, but now you sell it for less than the book value, then you have a loss. Okay, so that's it for the basic elements. Now we're going to go ahead and move down to what are the basic assumptions of financial accounting. Okay, so we'll just write in here basic assumptions of financial accounting. Okay, so we have 4 basic assumptions and we have them all listed here, so let's just go through them really quick. First one is the economic entity assumption. Basically, this just assumes that the economic activity of the company is kept separate from the economic activity of the owners. Okay, so they have separate books, right? So if an owner does something, he records on his books. If the company does something, it's on separate books from the owner. So essentially, the companies are viewed as separate and distinct from their owners. Okay. The next assumption that we have is called the going concern assumption. All right. And this basically assumes that the firm will continue to operate for the foreseeable future. This basically means that the company, basically what it means is that the company is just going to keep operating for as long as we can tell. Okay, and so this is very important for things like depreciation and a couple other things. So that way we can record depreciation expense and some other things as well. But basically, it just means the company is just going to keep operating. We're not going to liquidate anytime soon. All right. Then we have the monetary unit assumption. Pretty straightforward. It just assumes that the transactions are valued using money as the measurement basis. So meaning that in the United States, we would value transactions using the United States dollar. And then finally, we have the periodicity assumption, meaning that companies can basically divide their economic activity into specific time periods, such as months or years. Okay, so whenever a company creates its financial statements, it's obviously sort of artificial, right? But we have to be able to divide our accounting into specific time periods, such as months or years, so that way we can get a picture of what's going on in the company. Okay. In the next page, we are going to go through the main principles of accounting. So basically, we have the principles of accounting. Here, we have 4 main principles. Okay, the first one is called the measurement principle. Basically, this one, just really quickly, it deals with how a company measures the value of an asset or a liability. Okay. And we're going to talk about this more in the next section. So just really quickly, let's just go through. We just went through the definition very quickly, but we're going to go through a lot more specifics on what that means on the next page. Okay. But basically, it's just how the company values an asset or a liability. Okay. The next one is the expense recognition principle. And basically, this principle, it states that a company should match expenses against revenues the expense helps to generate. Okay, so what we want to do is that this is basically called the matching principle. Okay, there's something called the matching principle in accounting. And what it means is that we want to basically match expenses against revenues that the expenses help to generate. All right, and that just kind of logically makes sense because if we are generating, if we're having an effort to make a revenue, then it kind of makes sense that we would basically expense that effort against the revenue, okay? Such as, and we have a couple examples here. So basically, this means that the expense is recognized in the same period that the associated revenue is recognized. And so, some examples of this, it's called a product cost, okay? Such as materials, labor, and overhead, okay? If you can recall, we did a lot of this stuff in ACG 2071 in managerial accounting. And basically, we did a lot of stuff with, determining how many materials, how much labor, and how much overhead to actually allocate to a specific product, right? And so that's what we generally have for expense recognition. However, there is sort of an exception to the principle, okay? If an expense cannot be traced to a specific revenue account, the company recognizes the expense in the period it incurs the expense, okay? Excuse me. So basically what that means is that if the expense is not specifically like, okay, it's tied to a specific revenue, we just go ahead and expense it during a specific period when we actually incur the expense, all right? And so these are called something called period costs, and basically it's things such as an officer salary or expense, okay? Now we have the revenue recognition principle, and basically the revenue recognition principle just states that a company must recognize revenue in the period in which it satisfies a performance obligation, okay? This is going to become very important in this class, something called a performance obligation, and it's covered very extensively in Chapter 18 once we get there. But just very quickly for now, just so we can have just a rudimentary understanding, just a basic understanding of what is a performance obligation. A performance obligation is basically when a company makes a contract to provide a good or service to a third party. Okay, and so once we've fulfilled this performance obligation, once we've actually provided a good or a service, then the company recognizes revenue. Okay, and that's how the revenue recognition principle works. All right, and then we have this final principle here, which is the full disclosure principle. All right, and basically it states that any information that would make a difference to a user who is reasonably informed should be disclosed, right? That should just make sense. If it's going to make a difference in my decision, I want to know about it, basically, right? And so we have these three different ways that we disclose information. The first one is through the financial statements. Again, the basic financial statements are the income statement, the balance sheet, statement of cash flows, and the statement of stockholders' equity. So that's the first way. The second way is we have notes to the financial statements, and these provide a further explanation of the information found in the financial statements. Okay, so we might explain something about accounts receivable or something about, our bad debts or something about our bonds that are outstanding or whatever in the notes, just to give the reader some more information. And then finally, we have their supplementary information, which presents information in a different format or using different assumptions than what is shown in the financial statements. So we could have something like a forecast here, okay, or just some sort of a schedule that just gives us more information about what is found in the financial statements. Okay. Finally, we have one more page to go through. The first thing that we're going to go through here is just a little bit more detail on the measurement principle, just because it is a little complicated. Okay. So again, this is going to be the measurement principle. Okay. And so basically we have two methods to measure the value of an asset or a liability. Okay. And the first one is the historical cost method. And basically the historical cost method basically says that you're going to value the asset at the acquisition price of the asset or liability, right? So in this case, if I pay $10 for inventory, right? If I pay $10 for inventory, well, then the inventory's value is simply $10. Okay, that's literally it. It's just whatever I paid for it, that's the value. Okay, that's how we're going to assign the value to the asset that we bought. Okay. Now, this approach is seen as more verifiable because the acquisition price can be determined without any issues, right? No one's going to come and say, oh, well, no, you actually paid $20 for this inventory, right? It's very clear. You have an invoice and you know exactly how much you paid. The issue is that it might be less relevant as assets or liabilities are held by a company for a longer period of time, meaning that if a company holds onto this inventory for years and years, then that means that the market value of the inventory is probably different than what we paid for it. So in that sense, it's less relevant to the financial statement users, because the financial statement users would probably prefer to know what is the actual market value or the fair value of those assets today. Okay, and that's kind of where this second one comes in, the fair value principle, the fair value method of determining the value of an asset or liability. And so what we do with the fair value method is that we basically just say the value of the asset or liability is the market value of the item, recorded on the date of measurement. Okay, so whatever item that we're going to go ahead and record on the financial statements, Basically, what is the market value on the date of measurement? Okay, and so again, as an example, if we bought some stock, and the value was $30 when we bought it, we'll have a value of $30. Okay, put it on the financial statements. Okay, if the value were to change later, then that means that if the value changed to $40 later on, well, then our value is now $40. Okay, so it will just change. It will fluctuate over time, right? Versus with the historical cost method, that doesn't happen. It just stays on the books at what you paid for it. Okay, this approach is more relevant because it reflects the current cash equivalent value of the asset or liability, right? Like we just showed in this example here, if the value of the asset or liability changes, we're going to mark it up or mark it down, right? We're going to increase the value of the asset or the liability or decrease it, okay? However, it's less verifiable because the market value of the asset or liability is subjective, right? So you have to determine, what's the fair value of Apple's stock? Well, that could be different to different investors, right? And so we could potentially come up with some problems in terms of determining what is the absolute market value, right? And then finally, the Financial Accounting Standards Board, this is the FASB, okay? They have encouraged companies to use fair value as a measurement basis when valuing financial assets or liabilities, such as notes receivable and bonds payable. Okay, that's just a quick conceptual note. Nothing really major there, but just a quick thing to note conceptually. And then our last little piece here is that we have something called the cost constraint in the conceptual framework. And basically, it's just this overriding constraint of the conceptual framework, which states that the cost of generating financial information should be less than the value gained from generating the financial information, right? Basically, meaning that if we're getting some value greater than the cost. Okay, that's basically what we want to make sure we have. We don't want to just generate all this information because if it's not helpful, right? Because that's costing companies money to generate that information. And so we always want to make sure that when we're making information that people are getting value from it. So that's the end of today's, and I hope you found that helpful.